Hello everyone. Let's look at another type of non-taxable exchange, which is corporate formation or partnership formation. So corporate formation means, for example, the taxpayer transfer the property to the corporation to form the corporation, and they will get the stock in exchange. So in this case, there is no gain or loss. It's recognized when the taxpayer transfer the property to a corporation solely in exchange for stock if the transferor is in control of the corporation immediately after the exchange. Okay, so it means that if you transfer your property into a corporation, like if you transfer equipment, if you transfer cash into the corporation to get the ownership of the stock of the corporation, so in this case, there is no gain or loss. It's recognized. And there's two conditions. One is that the control is defined as ownership of 80% or more of the corporation outstanding stock. So it means that you should have around 80% or more of the corporation outstanding stock. But this control, 80%, can be determined in aggregate. Aggregate is mean if you and your friends or more taxpayers transfer the property into this corporation in exchange for the stock, and the control is about 80% or more, okay, for all of the taxpayer, then the gain or loss will not be recognized. Okay, and another one is a corporation will never recognize gain or loss on the exchange of its stock for property. So for the corporation, when they issue the stock for property, they will not recognize any gain or loss. Okay, and let's look at the basic. The basis of the stock received in the exchange will be equal to the basis of the transfer property. We call this one as substituted basis. The basis of transfer property to the corporation will be equal to the basis in the hands of the transferor. We call this one as carryover basis. Okay. So let's look at this example. So I have two people here, Phil and Liu. So Phil, he want to transfer 10,000 cash into this corporation, okay? And Liu, she want to transfer a building which has a fair market value of $10,000 and basis of $3,200. Now, in exchange, the corporation will issue 500 shares each for Phil and Liu, and the fair market value of the share will be $20 per share. Okay, so let's look at that. So let's look at Phil. All right, now Phil, he transferred 10,000 cash to get 500 share. Okay, to get 500 share, and the fair market value is $20 per share. So 20 times 500 is mean 10,000. Okay, so he get $10,000, okay, of ownership in this corporation. So the realized gain will be 0. We don't have gain. He transferred 10,000 and he get 10,000. So there's no gain here, no realized gain. Recognized gain is 0 because this is a non-taxable transaction. And basics of stock received. You remember the formula, basic of stock received in the exchange will be equal to the basis of transfer property. So the property that Phil transfer is cash, 10,000. So basic of stock received will be equal to 10,000. Okay. Now let's look at Liu. Liu transfer a building that has fair market value of 10,000 and basic 3,200 to get $10,000 of shares in this corporation, share capital in this corporation. So the realized gain here will be 10,000 minus basic of 3,200, which means that Liu gained 6,800. Recognized gain will be 0. Remember, because we don't recognize any gain or loss when we transfer property to a corporation for the exchange of stock. And it's also satisfy the condition because this corporation only had Phil and Liu, so their control will be 100%. And deferred gain will be 6,800 because we don't recognize any gain here. So how to find the basic of stock received by Liu? Basic of stock received by Liu will be equal to the basic of transfer property. Okay, basic of transfer property. So Liu transfer 3,200. So basic of stock received will be equal to 3,200. Okay. What about the corporation? When the corporation received the building from Liu, what will be the basic of the building? So we have the formula here. Basic of transfer property to the corporation will be equal to the basic in the hands of the transferor, or we call it carryover basis. So this basic of the building in the corporation will be equal to the basic in the hand of transferor, which is 3,200. So it will be equal. Okay. Now, let's look at another one, another type of non-taxable exchange. We call it wash sales. Okay, wash sales. So what does it mean, wash sales? If a taxpayer sells a security, it means stock, at a loss, but repurchases substantially the same security within 30 days after or 30 days before the sale, the loss is disallowed. Okay? What does it mean? So for example, if I sell a security, for example, if I sell a stock of Nike company as a loss, okay? And then after that, I purchase back the stock of Nike company the same amount within 30 days, okay, after the sale. So the loss that I have when I sell Nike stock, it will be disallowed, or we say we cannot deduct it, okay. Some taxpayer, they think that when they sell the stock as a loss, they can deduct the loss, and then after that they will purchase it again within 30 days. But the government doesn't want that happen. So the government say if you sell a security as a loss and then you buy it again within 30 days, that if there's any loss, you cannot deduct the loss. Okay. And the basic of the repurchase security will be equal to the cost plus any disallowed loss. So let's look at the example. On September 13, Dorothy sold Nike stock with a 4,000 basis for 3,750 cash. On October 4, Dorothy paid 3,810 to repurchase the same Nike stock. All right, you see that? So on September 13, Dorothy sold Nike stock with 4,000 basis for 3,750 cash. Okay, it means Dorothy sold Nike stock as a loss, $350 loss. All right. On October 4, what happened? Dorothy paid $3,810 to purchase the same Nike stock. All right, to the to purchase the same Nike stock because this repurchase happened within $30 of sales. Dorothy cannot recognize her $250 loss on the sale, the first loss. Okay, loss on the sale. She cannot recognize that, so she cannot deduct it from her taxable income. And Dorothy basic in her repurchase shares will be $4,060. It will be equal to 3,810 plus $250 of deferred loss. All right, 200 deferred dollar of the loss that is not allowed. Okay, so again, one more time, what sales mean? If you sell a security, a stock as a loss, and then you purchase again within 30 days, then if there's any loss, you cannot deduct it or you cannot recognize it. And the basic in the repurchase security will be equal to cost plus any disallowed loss. Okay, cost plus any disallowed loss. Okay, thank you everyone. That will be the end of chapter 9.